Non-farm payrolls, NFP, is a key economic indicator in the United States that represents the total number of paid U.S. workers, excluding certain sectors such as farming, government, private household employees, and nonprofit organization employees. The NFP report is released monthly by the U.S. Bureau of Labor Statistics and is one of the most closely watched data points in the financial markets because of its significant impact on economic policy, market sentiment, and asset prices. What the NFP report includes: employment numbers, the change in the number of employed people in the U.S. economy compared to the previous month; unemployment rate, the percentage of the total workforce that is unemployed and actively seeking employment; average hourly earnings, changes in wages, which are a key indicator of inflationary pressures; labor force participation rate, the percentage of the working-age population that is either employed or actively seeking work. Effects of NFP on financial markets. Stock markets, positive surprise. If the NFP report shows a higher-than-expected job growth, it typically signals a strong economy, which can boost investor confidence, leading to a rise in stock prices. Negative surprise. Conversely, lower-than-expected job growth may signal economic weakness, leading to a sell-off in stocks as investors anticipate lower corporate earnings and potential economic slowdowns. Currency markets. Forex. U.S. dollar. USD. The NFP report significantly impacts the U.S. dollar. A strong NFP report, higher job growth, usually strengthens the dollar as it increases the likelihood of interest rate hikes by the Federal Reserve. Conversely, a weak NFP report can weaken the dollar as it might lead the Fed to consider lowering interest rates or maintaining a dovish monetary policy. Bond markets. Treasury yields. The bond market reacts strongly to the NFP report because employment data is closely tied to inflation and interest rate expectations. Strong job growth can lead to higher inflation expectations, causing bond prices to fall and yields to rise. Weak job growth can lead to the opposite effect, with bond prices rising and yields falling. Commodities. Gold. Gold prices often react inversely to the U.S. dollar and interest rates. A strong NFP report may lead to a decline in gold prices as the dollar strengthens and interest rates are expected to rise. A weak report could lead to higher gold prices as the dollar weakens and investors seek safe haven assets. Oil. Oil prices can also be affected by the NFP report, though the relationship is less direct. Strong job growth could signal increased demand for energy, potentially boosting oil prices. However, oil is also influenced by many other factors, including geopolitical events and supply dynamics. Federal Reserve policy. The NFP report is a crucial input for the Federal Reserve when making monetary policy decisions. Strong job growth and rising wages may prompt the Fed to raise interest rates to prevent the economy from overheating, while weak job growth may lead the Fed to lower rates or implement other accommodative measures to stimulate the economy. Market volatility. Around NFP releases. The release of the NFP report often leads to significant market volatility, especially in the minutes and hours following the data's publication. Traders and investors closely watch the numbers and compare them to forecasts, with markets often experiencing sharp movements as they adjust to the new information. Because of its broad influence, the NFP report is one of the most anticipated economic data releases each month, and its effects can ripple across global financial markets.